entire system is levered. And when you have a system that is levered by design, that system has to grow. If it doesn't grow, it collapses.
The crack up boom and the failure of the currencies occur when every citizen realizes that not only is money printing something that's happening, but they realize that it's something that's happening and cannot stop and will only grow worse.
All right, everyone, welcome back to another episode of On the Margin. Today I am joined by Larry Lepard and Brent Johnson. Guys, welcome to the show.
Thanks, Michael.
Hey guys, how are you? Happy New Year.
Happy New Year.
Almost.
Yeah. Hope it was a good holiday for everyone. It's been a decade of a year, so congrats everyone listening to this for getting through it. It certainly has felt like longer than 1 year. Yep. But we've got a lot of really interesting ground to cover today, and I wanted to actually start things out with a review of, Brent, your dollar milkshake theory. So I'm sure probably a lot of the folks listening will be familiar with that theory, but if you could just outline it and describe how you still see the theory, that'd be great to just kick us off.
Yeah, I'll try to summarize it fairly quickly. Essentially, what I see happening, the dollar milkshake theory essentially describes how I think a global sovereign debt crisis playing out. And I think that we're going to have a sovereign debt crisis. Now, I've been saying this since like 2018, so it has not happened yet, and I'm the first to hold up my hand and say we haven't had it. Right now, debt does not matter. Everybody can borrow whatever they want, spend whatever they want, and everybody's just oblivious to it. But I think that will end. And when that ends, I think that the dollar will be the primary recipient of the crisis and the chaos that ensues. And I think the dollar capital flows from around the world will flow into the dollar and out of other currencies for several reasons. And I think when that happens, it ultimately pushes U.S. asset prices higher and pushes foreign assets lower. And it ends in this big crescendo, which will ultimately be really bad for the dollar and the United States. But over the next, let's call it 2 to 3 years, I think the U.S. is a better place to be invested than the rest of the world.
Brent, one of the things that I really like about your theory is that kind of the contrarian me, kind of perks up when I hear it, because I think a lot of us, I know both of you agree, and probably a lot of the folks listening to this show agree, that what's going on in central banking right now seems really, really excessive. But I think a lot of folks internalize that the negative consequence is going to be a very weak dollar. And I think not a lot of thought is given to what happens if we see a really strong dollar, which is obviously a really large problem for a global reserve currency. So I guess it would just be great to game out with you guys a little, do some kind of scenario planning or analysis or whatever. If we do see a really strong dollar, right, like the dollar milkshake theory predicts, what are some of the most, significant consequences of that happening?
It's it's a lot of negative consequences. I mean, there are so many knock-on effects of a strong dollar. It's hard to figure out where to start. But essentially, without getting into too much detail right away, and we can go into more detail if you want, the global monetary system is on a U.S. dollar standard. Now, you might not think that it should be, and you might not like that it is, but it is, right? And so right now, the dollar plays the role that gold played, from, call it, 1930 to or 1940 to 1970. Everything is kind of levered off of the United States dollar, and money, and not money, U.S. dollar money and other fiat money, whether it's euros or yen or reals or whatever it is loaned into existence. So the entire system is levered. And when you have a system that is levered by design, that system has to grow. If it doesn't grow, it collapses. But like any system that constantly grows, it will eventually go exponential. And exponential curves don't end well either. They go up faster than anybody can possibly believe, but they always collapse. And so when I look at the monetary system, I sit here and say it is inevitable that it collapses, whether from deflationary pressures or because they print too much of it and we get the hyperinflationary move higher. It's going to end really, really badly. The question is, when does it end? That's the understanding that the monetary system is going to fail. There's a little bit of value in that, but the real value comes out in figuring out when. And I don't think none of us know. We've all been speculating on this for years now. And I just think that regardless of which way it goes, we're going to have a lot more chaos this decade than we had the last decade, which is kind of hard to say when you think about it. But I just think that's where we're at. And I think the consequences are going to be economic, they're going to be social, they're going to be political. We were joking around beforehand about the fourth turning, which, it's kind of become a cliche because it's kind of become a popular book now, but Jesus, the guy wrote it 25 years ago and everything's coming true. It's pretty amazing that he was able to lay this out and then see it in real time. And, it's just a real mess. We were joking about how do you describe what's going on, and it's just a mess.
Yeah. I think that's right. I mean, I think one of the interesting areas where, we might slightly disagree on a go forward basis, I agree with basically everything Brent said. It's just how they resolve it. I mean, there will be a shortage of dollars. And I think that, in my opinion, is that it will get resolved in an inflationary outcome, that they won't let too much deflation get going, and that they will invent ways and reasons of printing and, doing, quote unquote, whatever it takes that will, literally, blind us with the light of just how outrageous it is. Because the alternative of deflation is just a complete collapse like the 30s, and they know that would be devastating, and they've said, they've clearly said it. I mean, Bernanke in his famous speech said, we have a technology, it's called a printing press. We can do whatever is necessary, and we will. And so I think the end game, I feel very strongly about this. I'd be curious to see how Brent feels about what the odds are, but I feel very strongly that the end game is worthless currencies, worthless paper currencies universally. Now, how quickly we get there and whether it's in my lifetime, and I'm 64, I'm not sure. But I think a lot gets told in the next 5 years, and I'm suspecting the entire story gets told within 10 years.
Yeah, I would kind of agree with that timeline. I know there's a lot of people who've been saying it's this year, and they've been saying it for every year since 1972, right. And here we are. And I tend to think that these are big moves. These are big moves with big global implications, and kind of by definition, these big global they end up taking a lot longer than you think they should, but then they happen a lot quicker than you think is possible when it does. So I'm kind of one of these people who thinks you need to be ready for it today, but I also actually don't think it's going to happen for 3, 4, 5, 6 more years. And when I say it, I mean some kind of a reset or culmination, or however you want to describe this this system that we have. I think just from a pure math perspective, something has to give, and whether they reset it proactively or whether they reset it reactively, I do think some type of a reset takes place, call it in the next decade.
Yeah, I hadn't actually mentioned that. There is the possibility that they get intelligent enough to do a reset to try and arrive at a global neutral reserve currency of some making before the whole thing, goes to tapioca. That inflation's running wild, and they all get together and say, okay, this is what we got to do.
Larry very correctly said they. And I don't want to put words in his mouth, but I don't think he just means the Fed. I mean, I think he definitely means the Fed, but I think he also means the ECB and the Bank of Japan and the Reserve Bank of Australia and the Bank of Canada. I mean, all of these institutions, first of all the leaders went to the same schools. They all know each other. They all learned the same thing, and they all believe the same thing. And so while on the one hand, they're competitors, on the other hand, they're colleagues. And it's not like one of these guys believes something radically different than the other, or ladies, and they're going to implement some. Well, I shouldn't say that. It's not that they can't, but they traditionally have all kind of done the same thing, right? And everybody's kind of in the same boat right now. And despite the tough financial situation that the U.S. finds itself in, so does Europe, so does Japan, so does Australia, so does China, right? And so the big, I guess, defining point of my thesis is not that the U.S. is better run or has smarter central bankers or has more altruistic, leaders. It's that I don't think that when you leave the United States that all of a sudden these political leaders and monetary leaders all of a sudden get smart. I think they're just as crazy as the ones at the Fed and, in D.C. And so I think, the point Larry was making about fiat currencies losing value, I completely agree. It's just that I think for several reasons, fiat currencies other than the dollar lose value and potentially go into hyperinflation long before the US dollar does, right? And I think that happening. I think if they're not proactive and if they are reactive, then I think it will lead to a progression of dominoes that fall rather than just a big reset all at once. Now, I can't rule out the fact that, like Larry said, you can't rule out the possibility that they get religion and they proactively head off some kind of a crisis. But that's typically not the way it's gone. And I think for several reasons, the U.S. is not going to give up its reserve currency status willingly. It may be taken from them, or they may lose it unwillingly, but I don't think that they will just one day wake up and say, we no longer want it. And so as a result, I think there is going to be a progression of, it's all going to be kind of one crisis, but I think it will advance in stages. And to the extent that the U.S. dollar loses its value or goes through some kind of a hyperinflationary event, I think it's the last one to do so. So again, just for anybody who's either not familiar with what I'm saying here, I don't want them to think that I'm a defender of fiat currencies and that I think it's a great system and the dollar has these wonderful attributes. It's really just my thesis is really just a consequence of the design.
Well, and there's a geopolitical. I mean, it's interesting. Brent started off by talking about all these bankers know one another, and the two big players that are important in this whole thing and are going to have a big vote on where we go are China and Russia. I mean, China being, arguably the largest economy, very close to it on a manufacturing base, although they have a lot of problems. And then Russia, being a huge supplier of energy, which we're now seeing is critical, absolutely critical to the survival of Western Europe, in any kind of a cold winter. And so, and these two countries have made enormous bets on gold. I mean, we know for a fact that China has a lot more gold than they report because we can see the records of what they've imported out of the Swiss refineries. And we know that Russia immediately turns around and converts the dollars they get from selling oil and gas or other euros they get selling oil and gas into gold. And so, it's there will be a lot of parties at the table. If a reset is to be discussed or arrived at, there'll be a lot of parties at the table, and all the parties will have slightly different interests based on the asset pattern of what they hold.
I mean, I think what makes now so interesting, especially, I'm a big lover of history, right? And I'm a big lover of other cultures and traveling, and I love going to other parts of the world. And, the history of the world is really about plunder and war and the scarcity of resources and the fight over resources, and sometimes that takes place via cooperation and sometimes it takes place via force. And I just kind of feel like this is really, like, in the truest sense of the world, for all the marbles, right? This is the big game. I mean, this is the global Super Bowl, and I don't know exactly how it's going to play out. I just don't think it's going to be a nice, easy, peaceful game of touch football.
Yeah. So guys, help me, Brent. I thought that was a really interesting point that you made, that the way central bankers view each other, not necessarily just as competitors, but actually as colleagues in general. And if you do look at central banking in general, a lot of different central banks kind of move in lockstep with one another. Every once in a while, kind of hear, the Australian central bank is hiking rates, 25 bips or whatever. But in general, central banks are kind of moving in lockstep. So help me put myself in the shoes of a central banker. What do you think they are hoping for here? Because sometimes you hear, I really think they're hoping for inflation, but then you got guys like Neil Kashkari coming out and saying we really, really don't want that. So what are they hoping for here when they're doing this experimentation with the monetary system? What's their best outcome?
If the central bankers could all get together in Basel, Switzerland, at the Bank of International Settlements, with they get together I think it's every month or every 2 months, I can't remember exactly which is a big Mordor looking like building. I don't know if you've ever seen it, but it's, talk about the evil empire or whatever you want to call it. That's it. But I think the ideal scenario for them would be able to do whatever they do, whether it's stimulus or QE or whatever, and engineer, let's call it 3 to 5% inflation over the next 10 to 15 years annually. And so over the next 10 or 15 years, they reduce the value of the debt outstanding by 50%. I think that would be it. I think if they could push a button and get that result right now, they would do it.
I agree. There's another argument that they might try something along the lines of the central bank digital currency. They know they've kind of got to go direct. Yeah. They know they've got to get money to the lower classes who've been screwed. I don't know. Sometimes I think that all they want to do is get through their term and dump the problem on the next guy. And yet then I see a guy like Jay Powell, who's actually, as we learned in New Hampshire, is actually campaigning to get reappointed. God knows why.
Yeah. Guys, I want to return to a point, one prediction, right, from the dollar milkshake theory, which is a rising dollar. Help me understand how that would actually translate into different asset prices. So on the one hand, I can imagine that, Brent, you kind of made the point. It's actually good to own U.S.-based assets, right? Because, a rising dollar means you have global funds flowing in, and that should trickle down into, companies and actually probably the bond market as well for the U.S. But, historically, a rising dollar has actually been bad for asset prices in general, especially risk assets in general have, had huge sell-offs basically when there's a rising dollar. Walk me through, if we do see the dollar milkshake kind of play out, we see a precipitously rising dollar. How does that impact different asset classes? Maybe if we want to talk about the stock market versus the bond market.
I think the first thing I would say is it kind of depends on the speed with which the dollar is rising. The reality is that in 2008 and 9, the dollar index, and I'll just use the dollar index because it's a widely followed index, but the dollar index was around 80 or 85 or something. And then after 13 years of QE, it's at 95, right? So it's gone up 15, 20% in the last 10 to 15 years. But over that time period, stock prices have doubled or tripled, right? And so it's not necessarily that a rising dollar is bad for stock prices. It's mainly when the dollar rises really fast and kind of the reasons why it's rising that tends to be bad. Because if it rises too fast, again, because the whole world is levered off of dollars, when the under-rising leverage rise in price, it tends to put pressure on the assets that are financed in that underlying collateral. And so that's, we basically had a margin call on the dollar. And this is really what happened in 2008 and 9 as well, is, the euro dollar system was starved of dollars, and it led to, assets being sold. And then, it becomes a self-perpetuating thing. When assets get sold, then you have to sell even more to meet the margin call, but your asset prices are falling while the debt stays the same. And then the same thing happened again in 2020. When you get a margin call on that underlying collateral, everything, regardless of whether you want to sell it, you have to sell it to meet that margin call. And so that's what I was talking about. You get the system where it either goes up or it crashes. And that was a situation where the underlying collateral was rising in price and the system was crashing. And so if this kind of goes back to my point earlier, is if they could get 3, 4, 5% inflation for 10, 15 years, I think they would love it, because under that scenario, maybe you don't have the crash. Maybe you have a slow stagflationary period of low growth in some assets, but certain, decent growth in other assets, and you just kind of slug along, right? But if you get a situation where the dollar goes from 94 to 104 in 2 weeks, which is what happened it went from 94 to 102 in 2 weeks in March of 2020. Now that's a problem. I don't even think where the dollar right now is around 96. I don't even think they really care where the dollar's at if it's between call it 86 and 96. I think they'd love to just keep it at 90 and keep everything nice and steady. But where it really starts to get problems is kind of the high 90s and the low hundreds. And then especially if it's going there very quickly, because it makes global funding typically takes place in dollars. It makes it more expensive, and it makes it harder to finance your operations, and it makes it harder to service the dollar debt for countries who have borrowed in dollars. Because if their currencies are falling versus the dollar, not only do they still have to service the debt, but now it's more expensive to service. So, but if they could get the dollar, so let's go back to the dollar milkshake theory. How I see it playing. If it were to rise steadily, I think it wouldn't necessarily be a sledgehammer to the system. But what I think will probably happen is we will have, the dollar will rise fast at some point. It will put pressure, Turkey's a good example. The rising dollar costs and rising dollar price is putting a lot of pressure on Turkey. And so then they're going to have defaults. But the problem is now Italy and Spain and France banks have lent a lot of money to Turkey. So now it causes contagion into those banks in Europe. And then perhaps it starts to spread to Europe. and then perhaps it starts to spread to the United States. So you start to get these contagion, these knock-on effects. So my guess is that we'll have some period where like March 2020, where the dollar will run up a lot, asset prices will come under pressure. They'll do some reaction like they did in 2020. The dollar will fall, everything will calm down a little bit, and then we'll get another run. And maybe this run goes from, 100 to 110, and another part of the world blows up. And then they come out and they do all these new programs, and for 6 months it's fine, or 9 months it's fine, and then you get another dollar run. And so I don't think that we're going to have this nice steady progression. I think we're probably going to have this period where we get these sudden bursts of dollar strength. But I think as that starts to happen, then I think people around the world, institutions around the world, companies around the world will start buying dollars to then put that into the United States, to invest in the United States, right? And so under that type of a scenario, if you're draining capital from the rest of the world and put it in the United States on a relative basis, I think the United States will outperform the rest of the world. And then it kind of becomes, a self-perpetuating system. Strength begets strength, and weakness begets weakness. And I don't know if I'm answering your question or not, but that's kind of how I see it playing out.
Yeah, I pretty much agree with that. He's got a point in that obviously if the dollar is strong against foreign currencies, I mean, that would in theory bring a bid into the U.S. bond market from foreign investors. And of course, we haven't really seen that since 2014. I mean, forgetting the milkshake piece of it for a moment and just looking at the bond market in isolation, the bond market is a great mystery to me, in the sense that, who would buy a bond in a deeply negative real interest rate environment? I mean, where are the bond vigilantes gone? And I think the answer to that question is hidden in the plumbing and the machinery that that is the Fed, that's more or less rigged the bond prices across the curve. I mean, they buy the tips, they buy the long, they buy the short. To me, bond prices do not reflect real price discovery. They reflect a manipulated market by an enormous government, the U.S. government, the U.S. Fed. And, so far they've gotten away with it because there's a certain amount of people who have to buy them because it's part of their mandate. But I think that group is growing smaller and smaller over time. And I think that the issuance is going to have to be bigger and bigger because of the social demands of the United States fiscal situation and politics, and the fact that, people who once given money, they're going to want more. I mean, I think, Biden, for example, will probably forgive the student loans, before the midterms. And, Manchin's holding things up now because they realize that inflation got out of control. But, eventually the damp's going to break and they're going to go back to spending because things are going to get hard again. And so, my view is ultimately the bond market is going to look at the Fed and say, sold to you. Because, a 10-year at 150, when, inflation, printed inflation, and we all know that printed isn't totally accurate, is, running 5-6%. It just makes no sense. You lose, the purchasing power of your principal pretty damn quickly, unless you really believe that it is transitory. And even the Fed has admitted it's not transitory. Ironically, though, it might actually be more transitory than some of us thought. I mean, just about the time when the Fed says it's not transitory, I see a lot of deflationary impulses. You probably do too, Brent, right?
Well, yeah, I actually think it's pretty funny that you brought that up, because whenever that was, a month or so ago, when Powell said something about we should get rid of the word transitory, and everybody's like, yes, see, I told you. And I thought it was kind of funny because any other time Powell said something, everybody disagreed with him and thought he was an idiot. But now that he says something that they agree with, he's really smart and he figured it all out. So
well, I actually think he's an idiot, because I think he's proving once again that he's consistently wrong, because I actually think we're about to have some softness in the inflation numbers, because all the money, the inflation was driven by all the money that got printed and everything that happened coming out of COVID. They backed off that a lot. I mean, I would have thought deficits, they did not do a lot of the stimmy stuff I thought they'd do. And so my sense is, just like in the 70s, there were periods of high inflation, but there are also periods when it went the other way. And I think we might be in one of those periods when it goes the other way right now. So, but I guess back to your question, Michael, I think ultimately the Fed will have to buy the bond market. If they want to keep interest rates down, they will need to implement, they already are to a degree, and the plumbing is so confusing, intentionally so, I might add. But they will have to buy the bond market, monetize the bond market, because I don't think any rational actor will be willing to hold that kind of paper at that kind of a negative yield over a long period of time. and that will, that will fuel a larger Fed balance sheet, which will fuel more money printing. Which, to me, the elephant in the room that nobody's acknowledging is just that people don't need to necessarily own these bonds. They don't need to necessarily. I mean, they need to own the dollar insofar as they need to service their debts. But beyond that, if you've got legitimate savings not levered, you've got two other choices, or many other choices, really. You could put it in real estate, you could put it in stocks, you could put it in gold, or you could put it in Bitcoin. And I think all of those categories will benefit vis-a-vis the bond market. I think the bond market's in a lot of trouble. To me, it sticks out like a big, red thumb of the worst place to put capital today.
I think over the long term that's absolutely correct. I think where it gets pretty interesting in the short term is that, again, I don't necessarily disagree with Larry's characterization here. But what I would say is look at the yield on a 10-year U.S. Treasury and not just look at the level of it, but look at how much it's fluctuated. And then look at the same yield on a handful of different European sovereigns and look at the level there. And then, but no, don't just look at the level. Look at the extent of the fluctuations. The U.S. 10-year has fluctuated much more than the 10 years of the competing European and Japanese sovereigns. And so Japan and Europe are how do I explain it? They are monetizing a bigger percentage of the total issuance than the United States is. And so I would say that while Larry's definitely correct in that the U.S. bond market is manipulated and it is not true price discovery, it's more free, and it has been allowed to fluctuate more so than the number of the competing sovereigns, and so I don't think anybody who buys these bonds is planning to hold them for 20 or 30 years. So that's number one. But then the other thing that I would say, and this is where I think it will get very interesting, and I actually don't know how this will play out. Again, nobody knows anything. We're all just speculating, but I agree that the size of the Fed balance sheet and the ECB balance sheet and the Bank of Japan balance sheet, it's indicative of the fact that these governments can't totally rely on external sources for funding, right? But I think before the Fed buys everything, I think there would be a step that would come before that, and I think they would mandate other institutions to buy them. And in other words, they could say to the banks, they could say to the insurance companies, they could say to hedge funds or whoever they are, pension funds, you have, or citizens in your 401ks and your IRAs, 25% of the value of your account has to be used to purchase treasury bonds, And if you don't, you're in violation and the taxable consequences will be X. Again, this is speculation on my part, but I would think before they completely monetize the debt by the central bank, they would try to force the private market to help them finance.
I think it's an excellent point. I think it's highly likely. I think another thing they'll ultimately do before this whole thing is over, in the whole money printing, around that they're going to throw, I think they're going to, because they've signaled it, Janet has signaled it, I think they're going to get the Federal Reserve is going to have the right to buy stocks. I mean, it's going to be the U.S. government IRA protection program, right? Which says that, in order to protect everybody's savings accounts and IRAs and retirement accounts, and keep the markets functioning in a rational way, the Federal Reserve is going to have the right to purchase the S&P 500 index and a bunch of other indices. And as a result of that, we'll look like Japan, or we'll look, somewhat like Switzerland. And, what that more or less is, it's just a formalization of what we know as the Fed put. We don't know what the strike price is on the Fed put on the stock market, but we know there is one intrinsically. And this would just make it formal. But all of these things, again, as they get unfolded, I think we'll go back to that von Mises point, which is, the crack-up boom and the failure of the currencies occur when every citizen realizes that not only is money printing something that's happening, but they realize that it's something that's happening and cannot stop and will only grow worse. And when that takes place in the minds of a majority of the citizens will, Gresham's law says, take all the savings, all the capital they can, and get the hell out of the dollar. Anything other than the dollar. I mean, or any paper currency in any country, because they realize that the governments have locked them into a system that is just programmed to debase that holding. And that's where, gold, Bitcoin, real estate, and maybe even stocks are all just going to go bananas, just completely bananas. And, it's going to be one hell of a mess, but that's kind of how I see it unfolding.
I'd love to get your guys' opinions on what is the catalyst for that realization. What does it take? Because I think a lot, like I'm a big fan actually of Ray Dalio's kind of theory here. He's got, short-term debt cycle, long-term debt cycle, and, his theory of beautiful deleveraging, which is basically this idea that all, productive growth gets driven by credit for the most part. And you kind of see buildups in credit that happen every 4 to 6 years. Then you kind of see the other side of that credit, but it always resets to a higher level of debt, and it kind of goes in this spiral going up like this until there has to be a large deleveraging, right? And these happen every 80 or so years. That's the long-term debt cycle. I think a lot of folks thought that would happen twice within the last decade or so. I think 2008, the great financial crisis, people saw as an opportunity to deleverage. And I think probably COVID, a lot of people thought that this was going to be the big thing that we've all been waiting for. And you know what? For all the crap that central banks get, central banks stepped in both times and effectively papered over the solution. You could actually make the argument in COVID, they did it too effectively, right? They might have just thrown gasoline on the fire, right? And the stock market has, doubled or whatever it's done since March of 2020. It's getting harder for me to imagine a situation where they can't step, even as I just heard myself say this, maybe that's the top, but, it's getting harder to imagine a situation where they can't walk in and just say, hey, here's, we did 5 trillion last time, we'll do 50 this time. What gets us to the end game here? What is the catalyst?
I think the whole system is going to get crushed, quite honestly. And so I don't think if natural markets were allowed to run their course, I think the dollar would eventually go through hyperinflation. But I don't think that will happen.
Yeah.
We don't like Larry is a fantastic advocate for sound money. And I would, if I had to choose between the two, I would most likely choose sound money as well, right? Real money, not central bank fiat. But, the history of the world says to me in a free market, gold would be money. But the history of the world also tells me very, very rarely have the powers that be let a free market reign for very long, right?
Good point.
And so I don't see how, and because I think the dollar's in the last in the line of these dominoes that fall, I don't see how we get to the dollar going through hyperinflation without some big conflict militarily or geopolitically, however you want to describe that, prior to that happening.
Yeah, I take the other side of that. I think we will. I think we'll get there. I think it'll just be kind of a natural progression with each, these contractions, these credit events and then responses are happening, more quickly, and look, this whole thing could take 20 or 30 years. Who the hell knows? But I mean, kind of 2000 was the first one, and I mean, Bernanke literally said, okay, well, just a tech crash. And they decided, well, let's create a housing bubble, take interest rates down. And that created 2008. And then, okay, then that crashed. All right, well, so, let's create an everything bubble. Let's hold ZERP at, for a long period of time. And we've gotten kind of continually out over our skis, and the next one will be bigger, the amounts will be bigger, the central bank, and more people will be aware of the issue. I was on another call earlier today, and we were talking about how all these Bitcoiners, they know Austrian economics because they read Safe's book. I mean, those guys didn't exist in 2008. Well, Bitcoin didn't exist in 2008. So the group, the knowledge of the fundamental underlying problem is slowly but surely spreading. My view is I look at it on kind of a tipping point kind of basis. And, I think more than 10% of the people now in this country are aware of inflation as an issue. And maybe not all of them fully understand it at the level that we were talking about, but they will over time as it continues to grow. And, the next one may not take 8 years. I mean, it took, 2000 to 2008, 2008 to, 2020. The next one might come sooner, and the dollars might be involved, might be larger. And And it's, when we kind of went from the technology level to the housing level to the sovereign debt level. I mean, what are we going to go to the interplanetary level? I mean, it's like, what can we inflate next? So,
Yeah.
and and again, I'm a, call me naive or call me a hopeless optimist. I believe we can get through it without war. That, the people, the issue we've really got is the centralized power at the government and the central bank level. And these people are just dopes. I mean, they're self-serving dopes. And, as more and more people come to realize that, and more and more people say this emperor is naked, they're going to get called on it. And if everyone was behaving in the way that sound money people do, which is buying sound money and abandoning fiat, eventually the fiat will fail. It's mathematics, right?
Yeah. I've got a question for you, Larry, just about sound money in general. It's actually pointed out to me that Alan Greenspan, who's kind of the architect of modern central banking, right, if you don't want to go back to John Law, who was maybe the OG architect of what we're doing today. But Alan Greenspan used to be a sound money guy, and he's got this great quote. It's like, why would I believe in sound money if governments aren't honest enough to enforce it, or something like that. So that kind of gets to Brent's point. I think there's something very seductive about the concept of sound money, which is it makes perfect sense when you look at it as an idea. It's this like beautiful alignment of incentives actually between governments and their people, and protects the your purchasing power and energy that you put into labor, all that kind of stuff. But almost as from like a philosophical perspective, I feel like the perfect solution isn't usually the one that humanity picks. We're a messy race of people. Like we often choose not great systems because we're imperfect, evolutionarily. And, my question to you is kind of that what Brent just brought up there, which is sound money is very seductive. We've had a gold standard for certain periods of time, but oftentimes governments wrestle control away from that. So what would you kind of say to that? What's your response?
Let me take that one. It's somewhat true and something that says, well, it's an ideal that can't be achieved. But I like to look at what I consider, kind of a couple of golden periods of sound money. I mean, probably the best one is the United States from 1789 until kind of the 19th century, and it wasn't as though somebody said, thou shalt have sound money, but we just did because gold and silver were money. And, there were crashes and booms and busts and so forth and issues, and there was wildcat banking and, Lincoln had the greenback. So there were non-sound money episodes, but in general, the standard of living increased enormously, probably the largest in history of mankind for American people between 1789 and 1900. I mean, some of the technological developments that occurred later in the century, but, and prices, I mean, nominal prices were pretty much flat during that time period. And so that, there were campaigns that were run on, what the country needs is a good 10-cent cigar whenever, when inflation came along. I mean, it was a period where there was sound money and there was enormous progress made. I think what happened is academia and others, including Greenspan later on, got intrigued with the notion that mankind can engineer things better than natural law, which is, in my opinion, kind of a flawed concept. In Greenspan's case, I mean, I think he was an Ayn Rand accolade, and he wrote about gold, and he fully understands gold. And he later, in his later years, kind of when he was still a central banker, said, well, we effectively have a gold standard, even though they didn't. He was lying. But he got seduced by the fame of it all. I mean, being the maestro was a very seductive thing. And so he abandoned his principles in my estimation. And there's some who say that he did it intentionally to blow the system up more quickly to get back to sound money, but I don't believe that. I think he just sold out.
He might be the guy that started the rumor that he did it to blow up the system.
Right, exactly. Exactly.
I know we're running near the end of our time here. You both have been super generous. Lots of food for thought here. You know what? I actually want to end it on something. I want to do one optimistic prediction from both of you for 2022. This is the first podcast episode of this year. We've talked about war too much, and I want a positive, something that you're excited about, something that gives you hope, something that makes you feel optimistic going into the new year.
I am absolutely convinced that in a year and a half, or by the end of next year, COVID is going to be a bad memory. That it was overdone, overhyped, herd immunity is being achieved, the variants won't be as strong, not as many people are dying, the fear will go away, And I think we have I think we'll actually have economic growth too. I think by the end of this year, the COVID menace will be gone, completely gone. And that'll be a beautiful thing. It's long overdue, in my opinion.
I like that one. I think that a lot of COVID will be behind us. I don't know if it's completely gone the way you're saying, but that would be a fantastic scenario for me. I think the one thing that I would say that is, I know sometimes I come across as a pessimist, and I always have to say, like, I actually do, a lot of the stuff that I think is going to happen, I don't say it because I want it to happen, and I'm not a depressed guy who's sitting in a dark room just with the cloud over my head. I'm actually a pretty happy guy. I'm a fairly optimistic guy. I think that we're going to get through it. That's what I'd say is, like, life, that cheesy line from the movie, like, life finds a way, right? Like, I think we're going to go through some hard years, but I think we're going to learn a lot of lessons that we've kind of forgotten. We had the greatest generation, 60, 70 years ago, and, we've lost a lot of that. And I think the one good thing about the fourth turning is that if you keep going, you eventually get to the spring, right? And I think whatever comes next, is going to be better than what we have now. I don't know that we're going to get there next year, but life finds a way.
Guys, you've already been super generous with your time. If folks want to find out more about you, follow your work, engage with you, whatever, what's the best way for them to do that?
Well, I do a number of these podcasts. I always enjoy coming on Blockworks and speaking with you, Michael. I think if you go to your website and search the history, you can find several different episodes. If you go to YouTube and do the same thing, just type in Brent Johnson or Santiago Capital, you'll get a number of links. I'm pretty active on Twitter. You can look me up under Santiago Capital, or my handle is @SantiagoAU Fund. And so I'm happy to converse that way as well.
Yeah, and I'm just on Twitter under my name. And then I have a website, ema2.com, which has quarterly reports and papers and letters. And I've given some speeches. You can Google my name. You'll see I gave a speech on sound money down at the New Orleans Gold Show, which I consider to be probably the best overview of how I see things. So.
Excellent. All right, guys.
I heard it. Thank you.
This has been a ton of fun.
Thank you very much, Michael. Nice to be on your show.
Thanks very much, guys. See you again soon.
Thanks, Mike.